In the beginning part of this presentation, I'm only going to continue the work I did in the last one, deepening our knowledge. Our knowledge should not be superficial. We should deepen it. So let's start on that journey. Some of these slides may be overlapping. Therefore, I'm not going to I'm going to be very quick with them, and then we will go to the crux of the issue. I've made this point. Equity and real estate are the only two avenues of investment that have consistently beaten inflation and increased the wealth of investors in the long run. In the long run, we mean by 10 years plus time horizons. We also examined gold. Timothy Green's brilliant saying about gold. The great strength of gold throughout history has not been that you make money by holding it, but rather that you do not lose. Gold will preserve the value of your money. It will not increase it, which means the return on gold will be roughly equal to the return on the inflation rate. And Timothy Green is not a financial expert, mind you. Timothy Green is a bullion expert. He's a gold expert. And when he is talking about investing, or when anyone talks about investing, please note that we are not talking about jewelry. We are talking about standard gold, a coin, a bar, a biscuit. Standard certified gold. Jewelry is a fool's game. You can use it for ornamental purposes, but you try to cash your ornaments, you are going to lose straight away 15%, if not more. If not more, on various charges. The ornaments are not standard gold. So whatever, just because you have seen a certain rate in the newspaper, if you have weighed your gold and you rush to the jeweler's place and the jeweler weighs and your weighing and his weighing is roughly the same, what you realize will not be roughly the same. It will be substantially less. So you can't invest via the jewelry mode. Jeremy Siegel, a Wharton business professor, who's written a good book called Stocks for the Long Run, he says this: in the long run, gold offers investors protection against inflation, but little else. Absolutely correct. Warren Buffett, the best protection against inflation is your own earning power. If you are the best teacher, you will command earning power and get your share of the national economic pie, regardless of the value of the currency. The second best investment is in a good company. I am not going to dwell on this too much because I handled it during entrepreneurship. When students at a university had asked him this question, which is the best protection against inflation? Giving him a leading question to get into stock market investing. His answer really stunned them. The best investment is not, or the best protection against inflation is not the stock market. It is your human capability. What you are capable of earning during your lifetime, whether from your employment, can you be the best employee? Whether from business, can you be an astute business person? Or whether from your profession, can you be a good lawyer, doctor, architect, any of these professions? So the best protection against earning power is your own ability, or what we call human capital, which very often we disregard. But human capital is the highest. After that comes financial capital. The second best investment is in a good company. This is a phenomenal saying from Warren Buffett. We saw this overlaps, so I'll be quick about it. In the long run, the market goes up. Rate of growth of investments comfortably exceeds the rate of inflation. We checked this out also, including these statistics. So we will not skip this. Yes, let's come to something else. Equity as an investment avenue. When complaining to SEBI, when crying about how much we lost on the stock market, investors always refer to themselves as investors. But what I call myself is not important. What is important is what I do, and do my actions certify that I'm an investor. Most of the people who are crying about investment fraud, or I got cheated by this stockbroker, I got taken for a ride by that banker or that insurance person, they are not investors at all. Investor protection, according to me, is almost a myth. Let me tell you, it's almost a myth. You know why? A genuine investor does not need protection. It is the non-genuine investors, the speculators who say that they are investors, who lose mainly because of their own foolishness, who lose because they do not take the trouble to get at least some basic knowledge about investment. These are the people who need protection from time to time. So, most of these people have no idea that what they are doing in the stock market is speculation and not investment. The first point that I want to make when we come to investing in the stock market is equity is a legitimate investment avenue. It can be used for pure investment. Second, equity is as legitimate an investment avenue as any other. It is as legitimate as a government bond, as the public provident fund, as a bank deposit, as your own financial stake in your business. As legitimate as that. There is no doubt about it. In fact, it can be much safer than most other investments. Interest rates, you can never be sure that if they come down, they will go up again. But equity returns are what we call mean reverting. They can fluctuate, but they come back to a certain trend line. They are much more predictable, as we saw in John Bogle's studies. So equity is as legitimate as an investment avenue as any other. Equity is the best wealth enhancement investment avenue for a common-sensed and disciplined investor. And we are very good at complaining that today things have become so complex. Today there are so many dangers, unforeseen things. I'm afraid no. I'm afraid I don't agree at all, because I'm one of the persons who has been fortunate or unfortunate to have seen the Indian securities markets go from an era which can be described as the bullock cart era to the Rolls-Royce era in this span of 3 decades. The marvels of modern technology can be harnessed by an investor much better today than in the past. Let me give you 1 or 2 examples. When I joined the stock markets in October 1985, this is the month, 31 years. We had a manual system of trading, 2 hours a day. Trading would be only on the floor of the Bombay Stock Exchange. Today it can be anywhere in India. You can sit in New York, register as an investor and trade off the internet on the Bombay and National Stock Exchanges. If you bought a share, you would be lucky if you got the share in 4 to 5 weeks. Settlements were a fortnightly settlements, then made a weekly settlements. If you sold a share, it would take you 5 weeks to get a payment. Today it's all 2-3 days. And just because you bought the share didn't mean you became the owner of the share. You would get a physical paper, a certificate and a transfer form. You have to fill up the transfer form, apply stamp duty, there were share transfer stamps. Then send it to the company for your name to be entered on the reverse of the share certificate as the owner. It was that cumbersome a process. There could be problems. Sometimes the company would reject the transfer, saying that the transferor's signature differs. There was a lot of fraud. That's been eliminated by the demat system. We had an era where there were no mutual funds. There was one pseudo mutual fund called Unit Trust of India, totally a public sector undertaking fund. We never collected a rupee for the UTI. Throughout every fortnight or month, some branch manager or other person used to come and beg of us, why don't you become UTI agents? We said no. Why? We have read the books. We know that what you are running is not a true mutual fund. You are an unregulated entity, a law unto yourself. But we are backed by the government. You can be backed by anybody. And sure enough, UTI had such a major problem about 17, 18 years back. And then the government had to bail them out to some extent, but people still lost. It was only after the 1996 SEBI mutual fund regulations, which were, by the way, just copied from the US regulations and tightened in 1 or 2 respects, that genuine mutual funds started coming out in India, and only after that we also got into that particular business. But when we talk about things becoming complex and difficult, it's because we allow them to become complex and difficult, or we fall for the trap of complexity. If we stick to simplicity, you will find that today things are much more simple and much more power is in the hands of the investor. I'll give you one example. We talk about an index called the Bombay Stock Exchange Sensitive Index. That is 30 stocks. But let me pay attention to another very popular index called the NSE 50 index or the Nifty index. I like the 50 stock index, that's better diversified. It's a good exercise today when you go back, open your newspaper and don't do any study. You know there are these 50 stocks in the NSE 50 index. Just read them. Just read the names of the stocks. I don't want even the share prices. They are meaningless. Read the names of the stocks, maybe starting from ACC and ending up with whatever Z Telefilms or whichever A to Z. It will take you to read 50 stock names, 3 minutes. That's all. Don't spend more time than that. What you will realize is that when you read these 50 names, you are talking about 50 major companies in India. I'm not even saying they are the best companies for an investor. They are major companies. And if you analyze a little more, you will find that this is a diversified portfolio of stocks. For your information, these 50 stocks come from about 20-22 sectors of the economy. And these 20-22 sectors are from 3 major segments. One is the services, manufacturing, and a little bit of a touch with agriculture. So just read them. Now, you would possibly say this is not a bad portfolio of stocks to invest in. But there are 50 stocks. How do I do it? 20 years, 30 years back when I started, that facility was not there. There have been 1 or 2 investors who actually asked me in the 1990s, wouldn't it be nice to just buy Sensex stocks? I said, yes, but you can't do it. You have to do each one, buy each one of them. You can't do it with a simple way. Today, you have the concept of an index mutual fund. Any number of the leading mutual funds in India have a fund by which, with 500 rupees per month, mind you, 500 rupees per month, you can invest in these 50 stocks. We take these things for granted. But it is good sometimes to reflect upon the power that is in the hands of the normal investor today. Our office has about half a dozen rickshaw drivers who are SIP clients. My partner owns a coffee estate. His staff are doing SIPs. There are mutual funds. When the rickshaw driver first told us, okay, we want to invest something on a systematic basis. We rang up the mutual funds. Do you have, what's the minimum? They said even some mutual funds have 1,000 rupees per month as the minimum, some have 500 rupees per month as the minimum. When we put it back to the client said, no, 500, I can afford 1,000. That means 500 was too small. 1,000 rupees also very easily could be afforded by a person like a rickshaw driver per month. Now, supposing we put this person into a Nifty index fund, let's say. Do you know what is happening in the whole process? That small figure, relatively small figure of 1,000 rupees is being taken, and this humble rickshaw driver, who may have no concept of the stock market, much less investment, becomes an owner, a very, very small owner, but an owner of, a part owner of 50 leading Indian companies. And every month he repeats the process in an SIP. Every month he renews his commitment to building up his stakes in those businesses. If this is not power in the hands of an investor, I do not know what is. This is a facility that is present in our so-called complex world, fast-paced, stressful world. Actually, all these stress levels and discomfort and complexity is something we become victims of. We don't need to do it. We can always look for the simplicity in those things, and we can distance ourselves from the complexity. John Bogle's classic book, common sense on mutual funds. The very first chapter he starts with something called Occam's razor. Razor is a sort of a saying, a proverb, so to speak. And he says Occam's razor is very simple. If you are confronted with a problem and there are 2 or 3 solutions, always choose the simplest one. So always start with simplicity. Or wherever you are, try to see whether I can make things more simple. We have used this very effectively, not just in investment, in our own business. From time to time we ask ourselves, are we doing some needless things? Can we fall back? Can we eliminate some things? Do we need to do this? Do investors really need this activity? If not, we are merciless. We will stop it. We will tell people why we are stopping it. Then it's up to them to continue with us or not. So, this is it. You can make things very, very simple. So, today there are numerous ways, numerous facilities, and the financial sector has brilliantly harnessed the power of information technology. From screen-based trading, from stock market trading, where the whole country and some of the neighboring countries are also the stock market today. Formerly, you had to make a pilgrimage to the Bombay Stock Exchange. Now you don't have to do it. You have an internet connection, you are the stock market. So equity is a great wealth enhancement investment, but the investor needs to be disciplined and exercise a little common sense. Equity also has a major problem. And the major problem is it can also be used for speculation. Real estate, we think of certain speculators in real estate. They are minor, let me tell you. Why? In order to speculate in a market, one of the most important conditions is that there should be ease of operations. In India, there is no such thing. There is no fluid market for real estate. It is property by property, and then the torturous process of engaging a lawyer, vetting a sale deed, even the presenting of yourself at the sub-registrar's office for registering a property itself is an agony in itself. So the ease is not there, and that is why people are forced to be a little longer term. There are speculators in real estate, but it is not that they are buying properties at 10 in the morning, selling the same properties at 10:30 in the morning. No. I was just reading The Economist, maybe 2 issues back, where they say that when you put everything together, the actions of individual investors, the actions of financial institutions, the actions of derivatives traders, the actions of everybody, you'll be shocked to know. I was shocked, I read it twice. The average holding period of an equity share in the US stock markets, we are talking about 5-year, 10-year, 20-year time horizons, it is 22 seconds. It is 22 seconds. Why? Ease of transaction. Can you think of the same thing for physical property? Physical property being held for 22 seconds and sold? No. You don't have those kind of markets. Now, those markets can help you to speculate if you want to speculate. But the same markets can also help you to invest if you want to invest. So, equity is like a double-edged sword. You own a revolver. You can use it to protect yourself if the need arises. You can also use it to spectacularly commit suicide. So, it's a double-edged sword. You can use it for both investment and speculation. Same thing with the stock market. So, this is an important slide. Equity is a legitimate investment avenue when we know how to use it as a legitimate investment avenue. It can also be used for speculation. And in a country like India, where legal gambling is hardly, maybe a little bit in the races, etc., all stockbrokers have been too happy to convert their offices into casinos. So, you get a lot of entertainment, your purse gets lighter, but if you've got the entertainment, fine, you've got something you paid for. Speculation. A trader reacts to price, an investor to fundamentals. An investor is someone who reacts to the fundamentals of investment rather than the short-term sentiment in the stock market. Do prices move you? Does your blood pressure fluctuate proportionately with the Sensex? You're a speculator. I'm reacting to price, always price. One particular share which I loved so much has either gone too high or too low. The markets have gone high, the markets have gone low. I'm very disturbed. These things disturb me. Once again, fall back on the one question that you should never forget. If I were a businessman, would this be my reaction? Just because some things are happening here, will it distract my focus from my business? When I work my 8 hours or 10 hours or 12 hours a day, am I working to calculate the worth of my business, or am I working to improve and run my business? These are the important questions. Let's go back to Benjamin Graham. The most realistic distinction between the investor and the speculator is found in their attitude towards the stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Attitude. That's why Jason Zweig said, you want to see what risk is? Look in the mirror. That is risk. It is my attitude. Do I have the investment attitude or the speculation attitude? What is my primary interest? Is it constantly which way is the market going? I should profit from it. Or should I be picking up stakes in suitable businesses? This is the important thing. Look at some business person could not find someone to succeed him in the business, so he wants to sell his business. Now there's somebody who wants to buy the business. What are those person's calculations? Is it I buy the business today, I sell it tomorrow? Or do I want to run the business? If I want to run the business, the questions arise. Am I interested in this line? Do I have the expertise to run this particular business? Am I knowledgeable about it? Have I made my dispassionate calculation about the worth of the business? Is the price being quoted outrageously high, or within a range whereby negotiation both of us can be satisfied? Having purchased the business at this price, am I going to be able to run it profitably and improve it and increase my earnings? These are the kind of questions that an investor would ask. The safest way to double your money is to fold it over once and put it in your pocket, as somebody said. Okay, get rich quick is not going to help you in the stock market. Another very old saying, 90% of speculators lose, and the 10% who say they don't are liars. Our mind always dwells on the happy events. So out of 10 transactions, if I have lost 10, those are swept under some sort of mental carpet. I'm dwelling on the 3 where I made some profits. And I'm talking about that, only those transactions. Markets reward investors and punish traders. We saw it in that slide where I told you about the variations. Ultimately, the reward is only with the investor. JP Morgan has this beautiful saying. JP Morgan is a very famous, they used to call him robber baron, but businessman of more than a century back. Bear markets are when stocks are restored to their rightful owners. When you have markets that are flat on their backs, index has fallen 50%. I always see in my office, you open your newspaper, you'll read the headline, markets hit a new low. You switch on the TV, everybody is crying there. Your neighbor who is a stock market investment, who 6 months back was having an extra peg at night because the markets were hitting a new high, now has the same extra peg at night because they are hitting a new low. I always tell my office people, when the index is 50% below its, for example, if the all-time high was 29,000, let's say that it comes to 15,000. At 15,000, there'll be financial journalists who will be, as usual, transferring the blank space from here to newsprint. And they will be saying that the financial markets are going to close. Okay, this is the end of equity as we knew it. When all these kind of things are happening, if we notice a client walking into the office and saying, can anybody tell me which was the last high in the market? So we say 29,000 odd points. What's the index today? 14,000 odd point. That means it's 50% down. We say yes. Okay, I want to buy. If I ever come, and there are several clients like that. If those clients walk in, I tell my staff, you are not to make any suggestions to these people or advise them. They are the genuine stock market investors. They don't need our advice. They have come to invest, invest. That's all. Follow their orders. Don't try to advise them or do anything of that sort. Bear markets are when stocks are restored to their rightful owners. Somebody who purchases when things are down and out, when everything looks gloomy and black. These are the people who are entitled to wear the badge of a stock market investor. And what JP Morgan said was absolutely correct. Absolutely correct. Templeton says, I never ask if the market will go up or down next month. I know there is nobody who can tell me that. Mark Twain, there are 2 times in a man's life when he should not speculate. When he can't afford to and when he can. And one more by Mark Twain, you can read it. Once again in slightly lighter vein. So all the months are mentioned there. Jason Zweig, Wall Street, like Las Vegas or the racetrack, has calibrated the odds so that the house always prevails in the end against everyone who tries to beat the house at its own speculative game. If you have noticed how a lottery works or a casino works, do you think that everybody is losing there? No, not at all. Otherwise, they'll have to close their business in 1 month. There are a huge number of winners. It's a percentage game. If my daily collection is 1 crore of rupees, I am going to return maybe 50 lakh rupees in the form of prizes to a select few. How am I going to arrange the prices? You pay a certain fee which is nominal, the prize is phenomenal. So when the prize comes, even if I am not very greedy, the money is so meaningful that I will jump up and celebrate. That is what the prize winner does. Now, what does the lottery owner do? He does everything to celebrate this prize and give publicity to the prize winner. Why? By doing this, the greed factor is played too. Somehow I think this one lottery ticket that I am buying is going to win the prize. We will not see what the odds are. We will not go into statistics at all. We will not see whether the whole game is to win. So Las Vegas has perfected this to such a phenomenal point. You go to the casinos, you play the games. Every few minutes there is someone who has won a prize and a lot of excitement. You see that you are losing, but you continue doing it. You continue doing it. You don't even see whether those people who have won the prize or won one prize, overall they are in profits or not, or that same money is going to be squandered again. So there is this excitement, and they will celebrate this, the prize winners. They'll give them a certain amount of glamour, and they are such experts at taking money from you. If the normal price to play a game there is something like 50 or 100 US dollars, finally when you are at the departure lounge of the airport, the casinos know by this time you have lost most of your money. The average fellow has lost most of your money. Even when you are in the toilet or somewhere there will be some advertisement signs, and you have to see those prices. They'll be all $1 tickets because they know you don't have much left. But even this we want to take from you. So there'll be a prize amount and you can buy this. So even that last dollar, as I'm leaving also, okay, I'll give my phone number and address and buy the last ticket with that $1 because no point in now advertising $100. You don't have them anymore. So what you would have kept for a cup of coffee perhaps somewhere, even that thing you're going to drop into the slot machine. So they are that good at taking it. So Wall Street is very good at calibrating the odds. Some people will win. Some people will. That's why you've got these stock picking contests. So many of them organize. The media organizes it. The broking house organize all these things. there will be one winner who celebrated. People who invest make money for themselves. People who speculate make money for their brokers. And that in turn is why Wall Street perennially downplays the durable virtues of investing and hypes the gaudy appeal of speculation. People will kill, believe me, for a 15% compounded return in India over 30 years. People will kill for that return. There's no fund manager or wealth manager who has delivered that return over that time. There's no one in India. Investors have got it. Why? Because they did not go to the fund managers. There they'll charge their fees, they'll partner you in the profits, they'll do a lot of things, and very often one recession is enough for half of them or more to close down. So they will not be there for the long term. Very few people last for 2-3 decades in financial services. Very few people last for 5 years. Forget about decades. For 5 years nobody lasts. It's all generally one boom and one recession and they are out. So the people who use common sense and invest, they make the money. But in the financial line, let me tell you, people will kill for a 15% compounded annualized return. And if you think you need financial experts, look at people who bought a house property, simple house property in Mangalore 3 decades back. A small little house on a 5 or 10 cents land. If you calculate what they invested in it, and today if they are going to sell it, you calculate that figure, run it in an Excel spreadsheet using the CAGR formula, you will get 15%. You will get the same by doing nothing. So this is a durable virtue of investing. I bought it, there was no market, there were no headlines about real estate. There were no daily real estate prices on this particular road, this survey number, up and down the prices jump, no. But the gaudy appeal of speculation, that is given publicity. That is why when I give my recommended list of reading, what are the books worth reading on investment? Every one of them will always be very moderate. They'll always say, this is not, in the first chapter itself, this is not a book that will help you get rich quick. In fact, there's a group called the Bogleheads. They are admirers of John Bogle and investors of Vanguard Mutual Fund. 3 of the very successful investors got together and wrote a beautiful book called The Boglehead's Guide to Investing. If you read the preface to the book, you will know the difference between the attitude of an investor and a speculator. You know what is written in that book? In the preface, these are not the exact words, but this is what is conveyed. They write things like, this book is written by us as successful investors to help other normal people become successful investors. You can do so by simple long-term disciplined investing. You can do so by earning well, spending less than you earn, saving the difference. This is not a book that will help you get rich quick. We do not even need to make money out of this book. Therefore, we are encouraging you to, if you want to buy this book, if you don't want, even take it from a library. If you have bought it, don't tell other people to buy it. You read it and lend it to other people. Okay, everything that is done is for them not to make money out of the book. This is the attitude of an investor, somebody who is actually giving advice. Versus, you will find any amount of trash, and this trash will generally have how I made $1 million in the last 1 year in the stock market, or some absolutely new technical analysis so far hidden, not known to mankind, but I have invented it yesterday. These kind of people are making money out of the sale of their books. So this is where this kind of speculation is really played up. Moving ahead, Warren Buffett. We have long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie Munger, that's his partner, and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children. So the fortune teller thrives on one thing. Out of 10 predictions, 8 may go wrong. they are quietly knocked aside. The two things that go right are given publicity. But you can get better results by flipping a coin because you're likely to be right half the time. This is never given publicity. Benjamin Graham, even when the underlying motive of purchase is mere speculative greed, human nature desires to conceal this unlovely impulse behind a screen of apparent logic and good sense. What he's saying is, it is so easy to confuse people between investment and speculation. So many times when stockbrokers want you to speculate, they will come out with sophisticated reports which look very well written, as if there are some economists all the time analyzing. You'll have reports with graphs, charts, deep analysis into industry, etc., etc. But at the end of the day, the purpose of each of those reports is to make you either purchase something or sell something, to transact.